So now you're like, okay, wait, I don't have bookkeeping. I just have bank statements. I'm concerned about an audit. I don't want to get audited, but if I do get audited, what are they going to look for? They're going to look at your bank statements. They're going to see how much money was deposited in your bank and how much money was spent. They're going to see what that money was spent on. They're going to be able to determine, was this business? Was this personal? Is this questionable? If it's questionable, do you have the receipts? Do you have the defense? Are you able to say that this was, in fact, business expense? When you get to an audit, the burden of proof is on you. You're the one who reported a certain amount of information to the IRS. All right, welcome back to the Know Your Numbers REI podcast. This is your host, Chris McCormack. Today, we're going to be talking about how the IRS already knows your income and what that means for you, how you can wisely and prudently and properly apply techniques to help you in the fact that the IRS knows your income, right? We want you to be following the law as best you can and to do things according to the law as much as you can. And part of that is reporting the income that you've made. There are people out there that don't want to do that. And those people are playing with fire, and it's not a place you want to be. We've had people come in our doors and talk about how there's some rental income that they're not too concerned about or don't really want to report, or Venmo transactions that they've received and they're not worried about. We'll just forget about those. That's not how we operate. That's usually a pretty clear example of who won't work well with us. We are committed to doing the right thing, and part of that is reporting the right amount of income and also taking the right amount of expenses. Many people believe that when they don't receive a 1099, it means that they're not going to have to report that income. And so that's what the basis of this conversation is. We've had people come and say, I didn't receive a 1099. I don't think we have to worry about that. And that's just not true. And so in the event that you don't receive a 1099, I want you to be aware of what you're going to be up against so that, one, you can be motivated to do things properly and report the right amount of income, but also, two, I think by the end of the discussion, you're going to have a desire to have clean records and report things properly internally so that externally, if somebody were to come and ask questions, it would be pretty clear cut. This is really for somebody who maybe might not have the best bookkeeping system up to date, and it doesn't really matter about income level. We had a prospect recently who was making $2.5 million in their wholesaling business, and their books were a train wreck. And we couldn't offer any tax planning because the books weren't up to date. And so we were recommending getting their books up to date and having us clean them up. And then through that, we would offer the tax planning that comes with that. But we understand that not everybody has that solid foundation of bookkeeping. And without the proper foundation of bookkeeping, tax planning is not really something that you can be exploring, because if I don't know how much money you made, yeah, your books can tell me that you made $400,000 in profit. But if I see 300 transactions that aren't categorized and negative accounts on the balance sheet, like that's a pretty clear example of your books not being accurate, profit's not accurate. I don't know what your taxes are going to be because I don't know what your income is. Today, we're going to be exploring, if you don't have all of the records, what is required of you? What is the IRS looking for? What do they know? And again, this comes when people come to us and say, yeah, I didn't get a 1099 from so-and-so. We don't really need to include that income. No, that's not how this works. You are responsible for reporting all the income you make. Yes, everybody's responsible for reporting 1099s for the contractors that they hire more than $600. And so if they didn't file a 1099, they technically are at risk of being liable for any interest or penalties that come with not filing a 1099. But if you didn't receive a 1099, you still are responsible for reporting that income. And this is why bookkeeping softwares are so useful, because every transaction that comes into your banks can be reported as income, and you don't have to worry about the 1099s that you're getting. So do not be deceived into thinking that you don't have to report income if the 1099 is not there. Platforms. So maybe you received income from PayPal or Venmo or Cash App, and you thought this was a way to circumvent the need for taxes, or the need to report income, the need to show on taxes. This, obviously, many of you are aware, is not the case. The payment processors like Venmo and Zelle and Cash App are now required to file Form 1099-K to those who are receiving payments through those processors. I would recommend not doing something like Venmo or PayPal. Stripe is a great payment processor. There's one called Provision Processing, which actually gives some cash to charities of your choices, if that's something that you want to consider. But I think businesses run well when they have a payment processor, obviously, because you can take credit cards and debit cards, and then you can link that directly to your account, and it will show up as income, and then you can report it in your software. You have to report all the income that comes from you, and just because you're using something that might be a little off market does not mean that you're free and clear and capable of getting away with it. That's not how this works. We talked about the red flags 2 weeks ago, and that's really the basis of this conversation, is like, if you are being audited, what is the IRS going to be looking for? How are they going to know how much money you made? What were business expenses? And so on and so forth. We know that a lot of people are surprised with how much they might be owing in taxes when we just get some information, whether it's their bank statements or their profit and loss. If we're going off of bank statements, just like the IRS, they're going to be going off of the amount of money that you're getting input into your bank statements, right? If you had $50,000 deposited into your bank, but $25,000 was a deposit that you made, but there's no way of determining that, and it was like a wire transaction, for example, then it looks like you made $50,000 in your business. And this is why bookkeeping is so important. Hey there, this is Chris. Thanks for listening to the Know Your Numbers podcast. Listen, if you are a real estate investor or business owner and you're set to cut a massive check to the IRS this year, you're going to want to hear this. Right now, I am taking on 4 new clients who want to save $400,000 or more in taxes. But the catch is this: what we are currently giving out as a complimentary tax assessment will soon be charging money for. So you only have a limited amount of time to get in the door. So the first 4 people who are willing to save $400,000 or more on taxes receive it completely free. Now is the time to plan for taxes, to save on taxes. And if you want to get in on this limited time offer, a free tax assessment with Better Books, you can do so by finding time on our calendar linked in the show notes. I look forward to meeting you and seeing how we can best partner with you for years to come. So really today I want to cover, yes, those myths that people come up with, that because they didn't get a 1099, they're not responsible for reporting the income, or because they're on one of these payment processors, they are free from reporting the income. That's baloney. But more than that, I want you to be aware of the importance of bookkeeping. What would happen if you didn't have bookkeeping and the IRS came and audited you, or was wanting to look further into what you're going for, and how you, as the taxpayer, as the business owner, as the entrepreneur, can further set yourself up in a more improved process and system so that everything's in order. You're reporting the right amount of income, you're taking the right amount of expenses, you're reporting the right amount of stuff on the tax return. And if the IRS comes, it's not something to worry about, because that's possible. If the IRS is auditing you, it's possible for you to not even sweat. And that's what I want. That's what I want. Because yes, the IRS might come auditing, but if you have everything in order, if you've reported the right amount of income, if you've taken the right amount of expenses, if you've documented it correctly, you don't have to worry, because they just want to make sure that everything is lining up. Your tax return matches up with your bookkeeping. But if you don't have bookkeeping, if you don't have a business bank account, then you're in for a lot of sweat and maybe some tears as well. So we covered the 1099s. Even if you get a 1099, if you don't get a 1099, you are still responsible for reporting incomes. Individual taxpayers are responsible for the accuracy of their own tax returns. Same thing goes with digital payment processors. Artificial intelligence and data matching. Again, I covered this 2 weeks ago. The IRS is well aware of technological advancements, and even though they still communicate via mail, they have software, they have resources, they have technological tools that are capable of catching fraud. So what do we want to do? We want to make sure that we're not raising any red flags by not falling prey to any of those 5 red flags that I covered 2 weeks ago. But we also want to just make sure that we're being honest. And we do that by making sure that we have the right reporting, right? If you have a bookkeeping software set up and you're doing this on a monthly basis and you're tracking your income and you're tracking your expenses and you're separating business and personal, you have nothing to worry about. It is the best thing for you. It brings the most peace of mind. It brings the most confidence. It gives you the ability to make informed decisions so that you can grow your business and know, yes, I can invest here because I have this much money in a savings account and I'm only going to pay this much in taxes. So I can make that decision easily and effortlessly. But if you're a mess and you have money here and money there and personal there and business there and no bookkeeping and you're just going off of bank statements and you're guessing how much money you're making, you are in for hell, for lack of a better word. It brings chaos, it brings fear, it brings anxiety. I've seen it, I know it, I feel for you, but it's time to set the record straight. So bookkeeping is your number one form of an audit defense. When you set bookkeeping up properly, when you separate business and personal, when you have a business bank account and money's coming in and money's going out, you now have the ability to keep clean records, to tax plan properly, to avoid the red flags that come up. And again, go back and listen to that episode. Again, the question here is, how does the IRS know what I'm making? And largely comes down to what's being reported to them and what you're reporting to them. But also, this is a game of technology. They have technological advancements that they're depending on. And if they're seeing one thing, but you're reporting another thing, then that's not good. And we avoid this by getting our bookkeeping software set up properly. So now you're like, okay, wait, I don't have bookkeeping. I just have bank statements. I'm concerned about an audit. I don't want to get audited, but if I do get audited, what are they going to look for? They're going to look at your bank statements. They're going to see how much money was deposited in your bank and how much money was spent. They're going to see what that money was spent on. They're going to be able to determine, was this business? Was this personal? Is this questionable? If it's questionable, do you have the receipts? Do you have the defense? Are you able to say that this was in fact, business expense? When you get to an audit, the burden of proof is on you. You're the one who reported a certain amount of information to the IRS. And so what we want, again, the importance is, yes, the IRS knows a certain amount of information about you. Yes, they have advanced technology to determine, are they reporting the right amount of information? Would we expect to see this much money come into their bank? Would we expect to see this much money go out of their business? But also, when you have bookkeeping set up, you don't have to worry. Bookkeeping is the best defense to an IRS audit. So even if you don't get a 1099, even if you take some payments on payment processors, even with the IRS using advanced technology like artificial intelligence and other technological advancements, you are still clear when you have proper bookkeeping, when you're investing in software, when you're using things like QuickBooks and doing it on a regular basis. And now you're reporting the income and the expenses that are going through your bank, and you're working with the tax planner to know what records you need to keep and how much detail you need to show and what are they going to look for when they come, right? If you don't have that, they're going to go based off of the bank statement deposits, and you're going to see that you're going to owe a lot more income than you would have if you had bookkeeping set. Small business owners, this is obviously, as business owners, you guys already the watchful eye of the IRS. The IRS is well aware that business owners are going to be making the lion's share of money in this economy. They also know that business owners have more of an incentive to not report properly, right? Because W-2 earners get a W-2, and if they get any deductions, it's itemized deductions, and those aren't going to offset it too terribly much. But if you're reporting business income and business expenses, again, they know that there's bad actors out there. They know that people can say one thing, but it could be completely off. And so they know that the bulk of tax fraud comes from people who own businesses. And so they're going to be looking at business owners, the industries that they work in and the expenses that they take, the income that they're making, to help determine, is this what we would expect to see? So at the end of this conversation, I know we've covered a lot. It's a follow-up to the red flag discussion, right? How does the IRS know how much money you're making? They know it from 1099s. They know it from payment processors. They know it through AI and historical evidence of what you've reported and what businesses like yourself have reported. And so with that in mind, we know that the IRS is aware of what we're making relatively and what we're spending relatively, because they have all of this data on tax planning businesses with 3 employees and a certain number of clients. And they also have information from the payment processors who are reporting how much income is being made by a certain company, right? If we use Stripe and they initiate a 1099K to us, then the IRS is going to expect to see that, plus possibly more if I'm collecting checks or using other processors on the tax return. It's pretty easy to determine who's being honest and who's not when they have so much information, is to keep good records. So how do you keep good records? You invest in software. Spreadsheets are no longer. You guys are all well past the level of spreadsheets. And even if you don't feel like you are, I'm telling you, the best thing you can do early on in your business or investing career is keep good records. And you do that by automating. Technology is great. Yes, it can be used against us by all of this data that they have on us, but it can also be used for our good because we have a clear understanding of how much money we're making. It's getting deposited into our bank account. We can record it as income. How much money we're spending, it's going out of our bank account. We can record it as an expense. With that, we can now make good decisions. We can now properly protect ourselves from the IRS. We can invest in things that we might not be able to invest in because we don't know how much money we're making and how much we're going to be taxed on and all of these things. So at the end of the day, with all of the information that the IRS has on us, what can we do about it? Keep good records. And then take the right steps to properly protect yourself by documentation. Expense whatever you can, legally and ethically. Take the right expenses, document it properly, and then consider alternative investments. Consider how else you can mitigate your taxes, right? Because if you're reporting all the income and you're taking all your expenses and then you invest alternatively and develop a greater tax benefit through oil and gas or real estate or what have you, another business venture, that's perfect. That's beautiful. Our goal is to save on tax, take away the frustration of those tax bills that constantly, year after year, nip away at your profit margins. And we do that by first getting ourselves in order, right? Jordan Peterson has one of his 12 rules of life. Get your house in order before you criticize the world. Before you go criticizing the IRS for all the information they have on you, get your house in order. Get bookkeeping done. Start keeping track of your income and expenses, running profit and loss statements on a monthly basis, making decisions based off of that. From there, we then create a tax plan and start scaling our investments in a tax efficient manner. I trust this blesses you. Until next time, God bless you and keep moving forward.